Gold surpassed $5,400 this week before pulling back towards $5,100. Most people think this is a normal correction, but the real reason is something almost no one is talking about: the surge in global shipping insurance and its hidden link to the oil market. Welcome to Money and Power. I'm Richard. Today we're looking at why the $5,100 level in gold may be tied to a critical break in the global financial infrastructure: the cost of insuring energy. To the members of the 2% Club sharing these reports on WhatsApp and SMS, thank you. You're the reason we remain the voice of reason. I'm here as an ambassador for your financial clarity, helping you look past the noise to prevent the mistakes others are making. At the time of this recording, gold is trading near $5,187 an ounce, and silver is just about holding at $88. Meanwhile, Brent crude is stubbornly stuck above $82. On Monday, we warned that $80 oil was the tripwire for global inflation. Today, that tripwire has been pulled. The 98% see gold dropping $200 and think the rally is over, but they aren't looking at the structural flaw. If oil remains elevated, inflation is locked in. This isn't a headline reaction. It's a structural shift in inflation expectations. When energy prices rise, everything else eventually follows. Gold and silver are not crashing. They are digesting a massive surge in the US dollar and bond yields as the market realizes a soft landing is now almost impossible. Now here is the institutional story no one is telling you. On March the 1st, the private insurance clubs in London, the people who provide the war risk cover for every tanker on the ocean, effectively walked away from the Middle East. Without insurance, global trade stops. Now in response, President Trump has done something unprecedented. He has weaponized the DFC, the Development Finance Corporation, to provide a federal insurance backstop for shipping. He is essentially nationalizing the risk that the private market is too afraid to touch. So why does this matter for your gold? Well, because the market is now testing the Trump floor. If the US government can successfully insure the oil trade, they can temporarily suppress the panic premium in gold. But there is a catch. You cannot print insurance forever without eventually impacting the value of the currency itself. This insurance shock is a temporary lid on a boiling pot. The 98% are currently selling their gold because they see the dollar index, the DXY, surging to 98.7. In fact, yesterday went over 99. They think a strong dollar means gold must die. The 2% Club knows better. We know that in 2026, we are entering a liquidity flush. Now, large institutions are selling their winning gold positions to cover losses in the bond market. This is a forced sale, not a change in conviction. When you see a high volume pullback like the one we saw at $5,100, in fact it did go lower, you're seeing the transfer of wealth from weak hands to strong hands. The East is buying the dip. Central banks are buying this dip. The question is, are you watching the price or are you watching the players? Now, look at silver. At $88, silver is proving to be incredibly resilient, to be fair. The gold to silver ratio is hovering near 58 to 1. In every historical inflation shock, silver eventually outperforms gold as the ratio compresses. The 2026 supply stress in physical silver is being compounded by the rising cost of mining, which is driven by, you guessed it, the price of oil. It takes energy to pull silver out of the ground. When Brent is at $82, the all-in sustaining cost for miners goes up. This creates a hard floor for silver that the paper markets cannot ignore for long. If you're in the 2% Club, you're using these ratios to identify where the value is hidden, while the 98% are chasing the headlines. We must now talk about the bond market. Yields are rising because the market is pricing in sticky inflation. Under the current administration's policies, we're seeing a massive push for domestic production, but that comes with a transition cost. The Warsh era at the Fed is defined by a refusal to bail out the markets at the first sign of trouble. This is why you're seeing volatility. The 98% trade was built on the idea that the Fed would always save the day. The 2% club realizes the rules have changed. We're moving into a period of high volatility where financial insurance, in the form of physical gold and silver, is the only way to opt out of the systemic risk. Now that brings me to the 2% brief. I've mentioned before that our external traffic from WhatsApp and SMS is massive. That proves you value this analysis. But I can get these reports to you much faster on Substack than I can here. In a week like this, where gold moves $300+ in 48 hours, waiting for a video to be produced and cleared by the algorithm is a risk you shouldn't take. By joining the newsletter, where we have the free tier or the inner circle paid tier, you ensure that you get my analysis the moment the insurance shock hits the wires. This is about notice. It's about being prepared before the 98% even realize what is happening. The link is in the description and comments section below. Now, as we move towards the end of the week, keep your eyes on 3 specific signals. 1, the $5,100 support. If gold closes the week above this level, the Trump floor is holding. 2, the shipping lanes. Watch for news on the French-US escort missions. If they face friction, oil goes to $90 and gold resumes its march towards $6,000. The DXY, the dollar index. If the dollar index pushes past 99, we may see one more liquidity flush in the metals. So this is not the time for emotion. This is the time for discipline. We're watching the hidden infrastructure of the global economy break in real time. The insurance shock is the first cracking the wall. I want to thank you for your continued support. Every tip and every share of our videos helps us reach more people who are searching for a voice of reason. We're on a mission to ensure that as many people as possible are protected from the financial mistakes that define the 98%. And I would finally draw your attention to the videos on screen at the end of this video and watch them if you haven't already done so. I'm also sending out various notes and briefs on Substack as mentioned earlier, and make sure you've signed up to that. This weekend I shall be opening the doors to the paid tier, but I still urge you to join the free tier, because if anything happens to this channel, because we say something the establishment does not like, we may find ourselves deplatformed, and if so, we can still remain in contact. Treat it as free insurance, just in case. YouTube deplatforms 5 million channels every quarter, and with AI making those decisions, one never knows who is next. The Substack link is at the top of the description and in the pinned comment section below. Thank you for watching. I'm Richard. This is Money and Power. Stay calm, stay informed, and I'll see you in the next briefing.